All right, let me go first. Can everybody hear me okay? All right. Usually I don't need a microphone, but the amplification is fine. So my name is Mohanjeet Jolly. I have the privilege, and I've been blessed over the last 2 decades almost to work with entrepreneurs and startups on 2 different parts of the planet. So I've done it in Silicon Valley, where I'm still currently based, by the way. But I joined a firm called DFJ, Draper Fisher Jurvetson, which has been around for about 35 plus years, with names like SpaceX and Tesla and Hotmail going back, and Skype and so on, under their umbrella of portfolio companies. So it was really awesome time for 9.5 years there, but 5 of those I spent on the ground in India, in Bangalore, setting up their India office and then making a bunch of investments, which I still continue to manage in that part of the world. So I create this bridge. So I've seen what works in Silicon Valley, I've seen what works, and oh, by the way, what doesn't in Silicon Valley and in places like India. And I'm happy to talk more about that. I don't have a prepared presentation, so my ask was that we make it very interactive. All of you come from different backgrounds, different geographies, different industries, and to the extent that I can, I will give you a very candid and honest feedback. So please make this interactive, ask as many questions. I'm here till about 4 o'clock when I have to run to Logan to catch my flight back, but even after this session is over, I'll stick around to answer questions one-on-one without disrupting the flow here today. So I will stop there and pass it on.
Thank you. Hi, everyone. I see some familiar faces, a few here. I'm very excited to be here again. This is my second year doing this, and it's always great to kind of see entrepreneurship well and alive outside of the United States. I a little bit of a background. I was born and grew up in Malaysia. Came here for college. 20. I'm a lot older than I look. 20 plus years ago. And I have stayed since in Boston, mostly for the last 20 plus years. And every time I go back to Southeast Asia, so my parents still live there, a lot of my family and relatives still live there. Just Southeast Asia alone, right, which is traditionally I think of as used to be a little bit more backwater in terms of internet startups and tech-enabled entrepreneurship. That's changed a lot, right? So I'm really excited to kind of see everyone being here. I'm a big supporter of what the Bootcamp does. A little bit more of my professional background. I've started 2 companies that was acquired, helped take one public. I also spent a few years in VC at Bessemer Venture Partners a while back, and I've spent time at big companies such as Cisco. I was trained as an engineer, so I've kind of seen I've been in a number of industries over the last 20 years, and I gotta say, it's every time I turn around, something new happens, right? It's the mobile wave, and now there's the AI wave, the IoT wave, the drone, the autonomous vehicle wave. I think there's no better time to be starting companies and to be involved in tech companies and tech startups these days. I think like Mohanjeet said, I love this to be a conversation. I don't have anything necessarily to present. So I'm open to questions, and I've probably made more than my fair share of mistakes as an entrepreneur. So I'm happy to share wins and losses and things you ought to watch out for as well. So yeah.
Actually, a couple of things that I'll add. One is, I am actually younger than I look. So he's older than he looks. So that's my problem. So my wife keeps saying, you got to go ahead and color your beard and all that. I said, no, I'm all natural all the time. So that's perfectly fine. The other thing I should have mentioned is I am also an MIT product. So I was Core 16 or Aeroastro bachelor's and master's. And I worked for about 4 years in a place called Lexington, Massachusetts, designing spy cameras for the military, which I cannot talk about at all.
He knows where you live.
Yeah, well, Google and Facebook, everybody else knows a lot more about me than even I do, by the way. So that's the new world order we're in. And then I spent some time at UCLA getting my MBA, and then worked at Mattel, the toy company. So any of you looking at some interesting consumer products, I might have some thoughts around that. And then I joined a gentleman named Guy Kawasaki. I don't know if you know who Guy Kawasaki is, but prolific author, speaker, etc. So he had this online investment bank, basically bringing together entrepreneurs and investors called Garage.com that he started in the late 90s. So I had the privilege again of working with him early on, and I was there for 8 years at Garage. Midway through that 8-year tenure, the bottom fell out. We were supposed to go public, all of that. None of that happened. And we said, okay, holy shit, what do we do? And so we pivoted, as we do. I mean, we're all sort of, I call startups, and I would consider Garage a startup, somewhat unelegant at times ballerinas. We're always sort of moving and kind of figuring things out and pivoting. And there, we pivoted from being a boutique investment bank to a seed stage venture capital firm. So I call myself an accidental venture capitalist. And so I started making seed stage investments in the 100 to 250, 300K regime. And that was a blast until DFJ came about. Completely, by the way, accidentally. I was judging a business plan competition at a university in Hyderabad, India. Happened to sit next to a gentleman who it turns out was a partner at DFJ, and we hit it off, and he said, we're looking for somebody to set up our India office. Do you know of anyone? I said, well, let me put my turban in the ring. Why don't you think about me? And so that's how DFJ came about. The purpose for going through some of that detail, and I was talking to one of the entrepreneurs a few minutes ago, this particular event, this particular week is incredibly special. So make sure you create some real bonds, because you have no idea how and when and where, not if, but how and where and when these bonds are going to, present themselves again. And so stay in touch, build these relationships, because in my career, there have been a bunch of step functions. Nothing was planned. Running into somebody, sitting next to somebody, hitting up a conversation on a flight. That's how interesting investments have come about, interesting relationships have come about. So anyway, so keep that in mind. This is a very, very special occasion, special week, special place. So leverage it. Don't waste this opportunity.
Yeah, I'll maybe give two views. Actually, I'll let Mohanjit give the VC view because he's got a more recent experience. But from an angel investing standpoint, so I do angel deals. I'm part of a few groups of folks that are fairly active. I think generally for us, it's we want to fall in love with the team, the idea, and the market. Right? I think it's very emotional. In the early stages, there's no metrics. A lot of times, there's not even products. Maybe a demo, right, if you're lucky. So I think a lot of angel deals, a lot of it, we realize that the active, experienced angel realized that, look, plans are going to change. Best laid plans, I guarantee you, no plans will ever survive contact with customers, partners, you name it. So you always want the team to be flexible, to be a well-qualified A+ team, hungry, persistent, smart, can hustle. And secondly, I think the market ought to be big, right? I think, as I think about market, I encourage you guys to think about degrees of freedom as well, because as you bob and weave, as you grow your company, chances are you're going to do a few pivots or a few small little changes to your product plan. You want to be in a market that's big enough to be able for you to go laterally sometimes within the market and reuse your platform. So I think that's really important. And I've had experiences where I've been in niche markets and we just can't pivot, right? It's boom or bust. And then the last one, so I think those are two key things. I think last thing is the product. To the extent that you have a product, you have a demo, you have something to show, there's a certain art in how you dress up the demo. There's a certain art in packaging. So the last thing I'll say here is I've seen the same exact idea presented as extremely unattractive and extremely attractive, right? So your ability, and I think this is true for a lot of people who come from technical background, myself included, right? It's like, it's all about the substance, right? But I think when you're out there, you're pitching, the narrative and the story is important, right? So think and spend time on the narrative, why it's compelling. You're gonna live and breathe and sleep this 24/7, so you know it by heart, but a lot of people who just have 5 minutes to understand your life's work, right? How do you communicate why that is your life's work? So I think those are the three things. I think it's, again, it's the compellingness, it's the story, it's the people. So,
yeah, I mean, just to extend that, you know, the framework that I've used for almost 20 years now, I call it the 3 T's and the M, right? 3 T's are team, technology, traction, and then M is the market, clearly. Now, you may be saying, wait a minute. By the way, technology is like a proxy for differentiation. What makes you different than everybody else? You might be saying, look, we're just getting going. I mean, traction, forget about that. We're really at the stage where maybe we have a team and perhaps we're going after an interesting market, which is fine. So if I could coalesce those 4, the 3 T's and the M down, the 2 most important to me are the team and the market, right? Because that's something you have control over, right? You can hopefully figure out that you're going after an interesting market. By the way, when you define market, define it specifically. Don't say I'm going after China. And so if I go, or India, I get 1%, boom, this is a huge company in the making. BS, right? Do the analysis. You guys are experts in your specific field. There are many in the venture field, by the way, who will pretend to be experts, but they're not. So just as an aside, I have a 2x2 matrix in my office. Actually, I have it in my home as well. I tell the kids to look at it every now and then. It basically has, I have 3 kids, and on the x-axis, it has humility to knowledge. On the y-axis, it has humility to arrogance, and on the other side, it has ignorance to knowledge, okay? So what ends up happening is there are lots of people who end up in this bad quadrant, which is a combination of ignorance and arrogance, okay? Not knowing anything, yet thinking or pretending that they know it all. So you guys know a lot more, and you're a lot deeper in your specific domain than we can ever be, right? So that passion and that communication has to come through so that I, as an investor, whether I'm an angel or a VC, am infected with your passion and your vision. You say, you know what, come what may, I want to go ahead and back this person, even though the person or the team may not have a whiz-bang product at that time. So there's you know, what you really need to do is, there was an interesting, which is being erased right now, the risk profile, right? You were about 10 seconds too soon. No, but think about that. Think about that particular. So let me just walk over and kind of use this. See, you can also put
over there. Yeah.
So there are angels here. There are VCs here. There are hedge funds here. What does this mean? This means that if somebody's writing you a 100K check, right, they're fine. This is their life. This is what they live and breathe. They're used to seeing companies that are purely PowerPoint and maybe a wireframe or a demo. All right, you get to a VC, we want some of that risk reduced. Early stage VCs may be here. Mid stage, which is where my new fund is probably closer to here, where we say, okay, you've got a team, you got to show me some idea of a product market fit, you've got to have some customers ideally paying, but even if they're not paying, some beta, alpha, gamma customers that are saying that, okay, we're piloting for 3, 6, 9, 12 months, and if you hit certain milestones and you're able to actually be that cancer drug rather than a vitamin that I'm looking for, I'm willing to pay you a lot of money, right? So that's where you're headed. So when angels invest, so going back to my garage days, we were writing 100 to 250K checks. turning 100K into $1 million return was fantastic. Right? That's a 10x in whatever, 7, 8, 9, 10 years. It's a great multiple, it's a great IRR, I'm happy. Going to DFJ, my previous firm, which is a $350 million fund, I put in $1 million, I get 10 out, it doesn't move the needle. So that's the other thing you need to keep in mind as you go through the journey of raising money, initially from angels and then venture capitalists, et cetera. Based on who you approach, know what their profile is. If they're a $300, $400, $500 billion fund, they're looking for a $100 million exit. They want to put in $10 to $15 million over the life of your company and have $100 million come back to them. If $100 million needs to come back to them, you work backwards from the exit. You say, okay, that means the company has to be worth $500 million to $1 billion. Because the VCs at that point will own somewhere around 10 to 20% of your company. So if you have a $1 billion exit and you're a $500 million company, that's a $100 million outcome. If you're a $500 million company at 20%, that's a $100 million outcome. Or 10% at $1 billion, that's a $100 million outcome. That is interesting as you approach certain VCs. On the angel side, they may be perfectly fine. Obviously, they'd love to have as much of a return as possible, but putting 100K and getting $1 million is a fantastic outcome. Right? So keep in mind who it is that you're approaching. I'll use a board again. There's something that I call, I just came up with this because I come up with these kinds of things. I call it the Credibility Continuum. Okay, Credibility Continuum goes from what I call dream, which is on this side, to reality on this side. Right? So you're 23, you're a first-time entrepreneur, you're selling a dream, right? Because the venture capitalist, the investor doesn't know you. So how do you create credibility? The way you create credibility is one of n number of things you can do, which is under your control. One, your fellow co-founders or employees. So somebody who leaves a cushy job where they're getting paid high six, mid six figures, and they say, you know what, I want to go ahead and work for this because I fundamentally believe in the disruption that this company can bring about, right? Two, in no particular order, by the way, advisors. And advisors, I'm not saying simple name dropping. What you do is you hustle, and you say, who are the top 2 or 3 people I absolutely want and need to be associated with my company? And come what may, I'm going to get them. I'm going to beg, borrow, steal, threaten, do whatever it is. By the way, it's being recorded, so I might have just shot myself in the foot anyway. But I have to bring my wife into every conversation that I have. So I am more of the, you've heard of the carrot and stick spectrum, right? So that's the spectrum. So I'm more of the carrot guy, like, cajoling, nurturing, saying, okay, let me incent you the right way to do the right thing. My wife, on the other hand, is more of a drill sergeant. And so I said, why can't you be a carrot? She said, I am. I'm just a frozen carrot, right? That's the. So whatever you have to use within legal framework, do and attract them. Because what is the investor looking for? Investor is saying, and the same thing will happen if you're going and selling a customer, right? Nobody got fired for using IBM. Here you are, first-time startup, blah, blah. Are you going to be even around 12 months, 18 months from now? All those questions go through the decision maker. And the way you convince them is by associating or having other people with credibility, with domain expertise, and hopefully some brand recall associate themselves with your startup. Ideally, also on the advisor side, if they can put in a token amount of money into your startup, fantastic. And it has to be, it can only be token. All you have to say to the investor is, these advisors are also investors. Because 9 out of 10 times, the investor is not going to ask you, the VC is not going to ask you, oh, how much did they invest? It's just the fact that they invested goes a long way. So anyway, just a couple of things to keep in mind in terms of creating that credibility, and then you get the initial customer, again the alpha, beta, gamma customer, and you move down that spectrum, saying we're no longer just a dream, we're actually building products, selling, etc., and we're getting some traction.
Now, that's not to say, to play counterpoint, that you always need to raise money, right? I think what we've talked about right now is fundraising. I need money. I need someone to invest for me to do something, right? True for a lot of the cases. Doesn't have to be, right? In fact, having started a few companies and being on the venture side, I would say the best kind of business is the business you own 100% of, right? You can tune it, you can turn it down, turn it up. In fact, the best business I've seen ever, it's a company called Built With. If there are geeks here who does a lot of coding, you know this. It's just a website that tells you what other websites, what technologies and stack other website uses. So they crawl, it's a modified Google crawler, if you will. One guy in Australia, half-time blogger in UK, $12 million a year in revenue. He's been working at it for 7 years. He was like part-timing for the long time. It was him and another guy. Weekend nights, weekdays, did it for a couple of years. The partner actually peeled off, right? But he was persistent. Did it after it hit, I think $500,000 in pre-orders. He's like, I'm done. I'm going full time, right? He doesn't need to sell it, right? There's no end. It's a cash cow, right? The gross margin is super high. Everything is pretty much automated. So, and there are many other examples that kind of fall into this category. Now, obviously, there are a lot of businesses you just can't do this by nature of the business themselves. So, I always encourage you, as you guys think about ideation, businesses, like what you guys want to do, there are two things I encourage you to think about. One is your passion. Second thing I'll layer on is what gives you the unfair advantage, right? And then if you have those two, right, then the question is, well, can you actually bootstrap this? All right? And if you can, you ought to push out the fundraising process as far as possible. It's infinitely easy, even if you raise money when you have more data points, to be able to say, look, this is a business, right? We may not be full-fledged, right? Versus trying to convince someone, this is an awesome idea. I don't really have a product, but you ought to believe me. Then it's really your opinion versus someone else's opinion, right? So that's I think the zeroth order, and you guys ought to think about that. So, yeah.
Actually, it's very interesting. I agree.
Yeah.
I agree. So my ladder of how you should actually get capital into the company: revenue, grants, beg, borrow, steal, venture capital. The reason, a little tongue-in-cheek, the reason is venture money is the highest cost of capital that you're gonna take. I am going to take a piece of your company, and you have to be ready for that, right? So venture capital, agree completely, or angel capital, outside money, is not for everyone, right? There are certain strings attached, right? It's OPM, it's other people's money, it's no longer your own. So in emerging markets, in India, for example, there was a wave that happened where the ecosystem was just developing. So this whole notion of taking venture capital was unknown. So entrepreneurs, a lot of times coming from family office or family business backgrounds, would say, okay, give me your money and then go away. Trust me, right? And trust is the one thing that is lacking in a place like India often. So you want to make sure that governance, and you're on the board, and you're helping guide the company, and there's transparency and things of that nature. So again, venture capital comes with strings attached, and you just have to be very, very mindful of it. So if you can do it, bootstrap it, have customers give you capital that you can then redeploy for growth, fantastic. I'll give you another example. One company that I have, it's called Delight Design. They make solar lanterns and home systems for people who are off-grid, so have no access to electricity. They have raised $13 million over the last 8 years in grants. So they actually have two people who are dedicated to raising money through grants and foundations, which is non-dilutive capital. Obviously, there are results and things that they have to do in response to those grants, but it just goes to show that even a startup can, in certain categories, have access to non-dilutive capital that you should try and explore if possible. Sorry.
I think that's a question at the back.
No, no, absolutely. That's why we exist. That's why we exist. Absolutely. So I'm not saying that, we should not exist and we're useless guys. I'm just saying that depending on the business that you're in, right? If you want to make it a lifestyle business, which is perfectly fine, you can get to, 12 million bucks. You're in control of your own destiny. You've got incredible cash flow, high margin software product. There's another guy, sits in India. People have been trying to put money into him called Zoho. Zoho is sort of has not taken a dime of outside money, right? So yes, there are. So if you're looking for industry connections, if you're looking for just that velocity or that exponential growth, depending on the kind of fund or firm and kind of partner that you can get access to, that could, in some case, in many cases, make or break a company, right? But all I'm saying is it may not be true for every company, right?
I can, absolutely, right? I would say most of the time, an investor, they're on the board. I'd say most of the time, your interests ought to be aligned. But there are absolutely time where it's not, right? So what are the cases? I think you're looking at what are some of the examples where it's not, right? So I'll give you one example that I've seen. Not all VCs do this, right? But there's some VCs that do, where company is doing well or doing well enough. The VC needs a couple of hits to raise their next fund, right? So there's an artificial constraint to exit, to have some cash distribution. So that's one that's happened. There are a bunch of others that's a little bit more less obvious. So I think you ought to be aware of all this stuff, right? I think my general philosophy with VCs is don't choose the firm, choose the partner, right? The way I have to think about VC, so if I take a step back, right? Choosing a co-founder is like choosing a spouse, right? In fact, you're gonna spend more time with him or her than your spouse, for sure. I guarantee you that. And then choosing a VC who's on your board is almost like choosing your in-laws, right? Because you see the person once a month or once every few months during board meetings, and you're like, oh man, it's like, fuck, I gotta do this board deck again, like the hell, right? So again, all this stuff, right? And it's humans, right? You got like all kinds of human personalities, mismatches, and all that stuff. So you ought to think of it as a very, very personal decision, right? You ought to think about what sort of person you are, what sort of person you get along and work well with, and do that match. And going back to your question specifically, right? I always recommend founders to basically have more than one heart-to-heart chats with the VC about some of this stuff, right? And just be open about it. Look, there are going to be times where my interest is going to be diverged from yours, and yours is going to diverge from mine. We ought to be honest about that and talk it out, because otherwise, you're going to start doing things that are going to waste time and be counterproductive. So anyway, so that's my thoughts.
Yeah, I mean that covers it well. Although I'll put another twist on the spousal comment. So you may be able to divorce your spouse. You cannot divorce your venture capitalists. So just keep that in mind, right? So the in-laws piece was interesting. I'll use that next time. I hadn't heard that, but I think it's true. But it's important. Look, the reality is this. Most funds are structured as what's called 10 plus 2. 10 plus 2 is they have a 10, if I raise a fund today, it has a 10-year life cycle. Then if I need another couple of years extension, I go back to my what's called a limited partner advisory committee, people who are giving me money to say, okay, it's okay to go ahead and extend for another couple of years. So there is absolutely that pressure towards the end of a fund's life to get exits, to get distribution, something called DPI, distribution per invested capital or invested dollar. That is the pressure that GPs, that venture capitalists, are under from their LPs, their limited partners. So it's very important to understand that aspect of it. Why not some other measurement or metric to gauge success or failure? Quite honestly, I mean, this is a system that has developed over decades now. And so our LPs say, look, what we care about is MOIC, multiple on invested capital, and IRR is simple for us to understand. We're in 75 different funds, so we needed to standardize, and that's how the standardization has happened, right? But fundamentally, I mean, what you're really looking for is, I'm a cash-based guy. You know, in India has a parallel cash-based economy, and so I'm a cash-based guy. I want to know that I put in X amount of dollars within a certain time span. I want to get Y, which is hopefully some multiple of X, out. And it's very, very true to have temporal alignment, right? So one of the questions that a VC will usually ask you, probably not at the angel level, but definitely on the venture side, is perhaps, what do you think the exit scenario is here, right? Now, what they may be looking for is for you to say, look, you know, what I want to create is a sustainable business, sustainable, profitable business, large business, and we will explore exit options as and when they come, right? But I think if I do my job right, I can get to X 100 million in revenue, and we can explore, you know, public options at that point. But the focus right now is to build a large standalone business. That's what they're really sort of hoping for. But from your standpoint, you've got to know that, look, there's an exit when the VC gets their cash out and goes, and then, you know, you may need to continue from that point on. By the way, the other thing, keeping in mind your sort of marital relationships, and this is very, very important. I've seen marriages fall apart. I've seen divorces happen because the conversation basically, you know, goes something like, hey, are you married to me, or are you married to your startup? And what you really want to say is, I'm married to both, and I love you both equally. But that may or may not get to the desired result. But it's very true. When you first get going, when the risks are high, when the odds are against you, and you guys all know this, and still you go ahead and do this, which is fantastic, have a timeline, right? Have an open discussion with your spouse, with your significant other, and have a timeline that says, you know what, I'm going to give this 6 months, 12 months, 18 months. What you shouldn't do, at least in my humble opinion, is artificially keep pushing yourself, trying to convince yourself it's just around the corner, it's just around the corner, it's just around the corner. And when there are too many corners, you just end up going in a circle. So it's very, very, you know, self-awareness, I guess, is the phrase that I love. Self-awareness is definition of knowing what you know and being humble enough to acknowledge what you don't. And having this sort of timeline, having this understanding with your family, because this is going to put a lot of pressure. Financial, psychological, physical health suffers, right? You're on planes, you're driving all over the place, you're thinking about your 6 a.m. call with some part of the world, and you've got a midnight call, and you're getting by with 2, 3, 4 hours. You guys haven't slept in the last 3 days, right? So imagine, right? Eventually a body divorces you and said, okay, to hell with this, right? And so keep all those things in mind and be pragmatic about it, right? I'm not saying don't be tenacious and persistent. I mean, that's what you need to be. But set certain milestones, set certain goals for yourself.
On a longer-term perspective, I've got a friend who's a major investor. He told me that for larger companies, it takes a decade to really penetrate the market fully and start making maximum profit in the years 10 to 15. capital investments have been structured over the last 50 years to go from 20 years, which they used to be, down to 3 to 5 in many cases today. You mentioned 10 plus 2. What are options for patient capital beyond a 10-year time frame? Are there any out there?
I mean, the short answer is yes. There are evergreen funds, right? So who don't have to go and knock on doors to raise capital every time. So you have one family, right? So Bessemer, for example, is like that. They've got it's sort of evergreen, right? So they don't necessarily. I mean, obviously they still have their internal metrics and so on. So they're gonna still want to be within that reason, but I'm not sure unless you get into sort of the hedge funds and those types of folks that you're going to run into somebody who's got that kind of patient capital, because for most of them, no.
But I think realistically, if a company is doing well and continue to kind of have that growth, 10, 15 year, you're going to hit the point, practically speaking, that you would either need to tap the public markets or sell. Now, again, there are always exceptions, right? It could be a cash cow company. I'll give you an example, right? Gearson Lehman Group, Expert Network. We did the deal when I was at Bessemer. I can't publicly say returns, but it's a cash cow for the longest time, right? It just spews out cash. Not a public company. It can't go public because of regulatory risk and a lot of stuff. Growth rate, they're growing good enough, but not like Facebook growth. So there are certain things like that where you do get a return on that. So I would say, I agree with Mohanjit, right? There are certain funds that are more patient than others, but by and large, investors ultimately want to make a cash in, cash out return, right? And once you drag beyond the sell, it takes an average company 8 years to go from zero to some sort of IPO exit, right? So once you're kind of out of that bounds and you're not tracking, generally investors will probably pull you aside and kind of talk about exit vectors.
Actually, another thing, I'll give you a specific example as well. So SpaceX, right? So Elon Musk's company, SpaceX. Elon has no intention of taking that company public, right? So DFJ invested. And so the early investors, how the hell do we get out, right, in that particular case? And so there's a very interesting and thriving what's called secondary market, secondary mechanism that exists where late stage investors come in and they're perfectly fine getting dividends, right? If cash is generated, they want a steady income stream, steady cash stream, perfect. The company doesn't have to be public, boom, boom, boom. They do their cash flow analysis. And VCs who bet early when it was, the dragon was still on paper, they get out because, whatever, Fidelity or whoever comes in and buys their stake. So this secondary transaction is yet another way that VCs do exit. Yes.
Following up on that, if you were to make fintech or a biomedical startup that it would take 5 to 15 years, what are your views, pros and cons, to go to a corporate VC instead of a gamble person?
The interesting thing is in almost 20 years, I've had fantastic outcomes with corporate investors, and I've had very negative outcomes with corporate investors. I think what has to happen to make it work, and I think in many cases it does work, and it can, and it's mutually beneficial, is you want to avoid being pigeonholed, right? You want to avoid being pushed in a corner where a Cisco comes and says, you will only work with Cisco, right? I'm like, okay, well then I just shot myself in the foot, and the market is a fraction of what I thought it was going to be. There are others who are more reasonable, who'll say, you know what, we understand as investors, we want our valuation, our piece of your company to grow in value, right? So we don't want to shunt it. But how about this? How about if you give Samsung a 6-month exclusive? Right? So make it an exclusive that's time constrained, geography constrained, or some combination thereof. I think that's fine. Beyond that, it gets a little tricky, and I think in general ends up harming you in the long run more so than, because then you only have one exit option, which is to that particular corporate who's got all the chips, right? So you have no leverage at that point.
So how do you evaluate the person coming too much of scope for innovation. Innovation can happen, but it won't be explosive innovation. Okay, how do you develop? How do you evaluate, such kinds of proposals on what matters?
Yeah, so from my standpoint, I go back to that same curve. Um, so I look at some combination of true intellectual property and disruption versus traction and the market actually validating what it is that you're selling. So it's it's IP versus IT is what I call it, right? So it's intellectual sort of innovation versus sheer execution. Now, often, someone like me will say, I'd love a combination of the two. You have an unfair advantage, going back to the previous comment, and you have the execution and capability to be able to, hit the ball out of the park. I think if you're in a crowded space, right? If you're in a crowded space, the level of intellectual property or level of innovation or disruption has to be much higher to really stand out. Because if you're a Me Too or perceived to be a Me Too, then you're going after or going against potentially dozens of other investee or companies who've taken in capital, right? So I'll give you an example. In India, if you're another food delivery service company, say, oh, I've got the best UI and I've got this. No way, right? There are 25 food delivery companies that have been funded, right? What's going to make you really, really, unique? Maybe you have some sort of an AI angle. Maybe you have something that's truly different. Then yes, I'll pay some attention. But otherwise, I'm going to look at traction data. I'm going to say, you know what is your DAU, MOU, ARR, all these three-letter acronyms that we love throwing around, but basically saying, are the dogs eating the dog food? Are the customers sort of clamoring for your product? You need to show me that. So it's got to be, ideally both, but in a crowded market, in my mind, innovation, disruption, and IP. Otherwise, yeah, I mean, if you can create a virtual monopoly or duopoly, then you right time, right market, you can get that scale, and that gets all of us excited. And then you can tell us, I don't need your money, right? The best time when VCs want to give you money is when you don't actually need it, because we're saying, aha, traction, herd mentality, let's go. This is a hot company, and then you can pick and choose. You can say, either I take it from you or I don't take it at all because I'm on my way. When is the best time to take money? When you don't need it. Seriously, I mean, because that is when the VCs will come knocking. What you want to do is you want to create a market. You want to create this sort of scarcity that says, I'm only taking 2 million, 3 million, half a million, whatever it is, and then let the VCs or the investors duke it out. You end up with half a dozen term sheets, and then you're in the driver's shoes.
So there's a whole psychology on this. Actually, it's really important that it's like dating, right? You don't want to be the guy or the girl, whatever, like in a bar, talking to everyone, hitting on everyone. Because by the time you got to the 12th person, everyone knows that you've talked to a lot of investors and they're not putting money in. Your deal becomes stale. So there's a whole art of managing perception, managing the process. In fact, I think that's one of the most important things that to actually get to not just a deal, but get control of the process, valuation, and things like that, right? There's a whole big discussion, but we can take it offline. But I know there's a question somewhere around there.
What is your advice for new companies that are developing new technologies, like disruptive technologies, that you have like maybe a small prototype that you have to develop it and it's gonna cost you more than, I don't know, 2 million in your first round, in your round phase. So what is the advice and what should we focus?
Yeah, so there are ways to operationalize some of this like gaps, right? What I call like man, you've got this thing, you just need that little amount of money to kind of take it to productization and things like that. So there are a few tricks to do that. One is you get customers to prepay, right? So you get customers excited, this is gonna solve a big problem, all that stuff. You basically say, look, not looking to raise outside money, we want to be self-funded right now. You develop a relationship and then try to convince them to say, if we can build this, will you prepay part of it, right? Now you need to worry about contractual terms and things like that. Give them a sweetheart deal. most of the times it doesn't work because they'll be like, we need to see it. But there are times I've seen it work where people are just good salespeople and they've earned the trust. I think that's one. Another one we've seen is to actually look at it not from a product standpoint, but from a consulting standpoint, right? You go in there, me and my team, we are consultants, right? We're building, by the way, a product in this, so you have to be clear about the IP rights and all that stuff and be upfront and not spring it on them. But then you basically say, look, part of this, I'll give you a deal, part of this is to educate us so that we can build this product that ultimately we can come back and let you use it as a discount, but you ought to pay us to come up with a customized consulting contracting solution for you. In the meantime, that's going to fund our product. So there are different shades of that I've seen people do it. Now, there are costs, right? It takes you longer. Some of these consulting stuff takes you off track, off path, and then you got to circle back. It's time primarily, but those are some of the ways.
My question is, to what extent does a founder stop listening or stop being driven by management VC? For example, in India last year, there was crazy discounting, and now we see extreme focus on profitability. So as a founder, how do you keep yourself steady and for the rest of the company while still managing other stakeholders?
It's a very good question. So just so everybody knows, India has gone through basically all of 2015 and beginning of this year, an incredible amount of euphoria around e-commerce especially, where companies basically were adding $1 billion to their valuation every 2 to 3 months, right? And the way there was complete irrational behavior. And I don't blame the entrepreneurs, by the way, because the VCs are valuing companies based on what's called GMV, gross merchandise value. All the stuff that's flowing through, irrespective of whether it was positive or negative gross margin, forget about profitability, right? So the incentives were such that the entrepreneurs were driven by GMV accretion rather than margins. And so look, if I'm in that situation and somebody's willing to write me a $200 million, $300 million, $500 million check, if I keep hitting my GMV numbers, darn it, I'm going to do it, right? Because that's the game that was being played, and you needed capital to discount, and then grow the GMV to raise more capital at an elevated valuation, and it was almost like a Ponzi scheme that was eventually going to crash. And so over the last 3 to 6 months, that has happened. Now, the entrepreneurs who knew that that was coming, and I would imagine that all of them knew that that was going to be happening, and that they were doing artificial or unnatural acts just to be able to raise capital. I think what they have now decided is, I'm sitting on $200, $300, $400 million of cash, and I have to go under the assumption that I have zero additional capital available to me. So I've got to get to sustainability, cash flow positive on the capital that I have. So that's the mindset shift that has taken place. And I would argue that those entrepreneurs actually had that acumen to begin with, but they were shoved into this euphoria that the hedge funds and the sovereign wealth guys brought to the country to just elevate these companies from 50 million to 100 million to 10 billion in the course of 2.5 years. I mean, it was insanity. And now the good news in all of that is a lot of people came online. A lot of people became e-commerce, m-commerce customers. And those that have now realized that unit economics and gross margins and ideally profit margins are what matters, are able to sell to a much larger audience and hopefully get to that sustainability, right? But what you have to do, this is something I struggle with, is you have to be honest with yourself and say, am I doing something that is so unnatural, borderline unethical? And there were some of those things going on as well. And there were some who recognized it and say, I'm going to stop it even if it costs me market share. And there were others who said, it is the business in India, so I'm going to keep doing it as long as I can. So that's what I think you just have to be, that's where your internal sort of value system, takes shape and say, okay, am I doing it just for the sake of doing it? Am I doing it because I genuinely, honestly love it and I want to make a difference, and I want to leave a legacy behind. I mean, that's the other thing, by the way. As and when you're setting up these companies, please, please think about setting aside enough for not only just co-founders, but your employees. Make sure the incentives are aligned. I'm seeing this in Southeast Asia, I'm seeing it in India, where there are companies that are not doing anything, even though they've had exits in the hundreds of millions, the employees have actually seen zero, right? And that is not how you build an ecosystem. And so to the extent that you are from some of those different countries, change the dynamic. Have some of the US-based thinking sort of come into your geography rather than having it be all about me, 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 which is unfortunately a lot of what I'm seeing in my part of the world.
So my question was, based on your previous statement where you said we should be approaching VCs only when we don't need the money. So could a reason of approaching the VCs could be some sort of like a contact or anything like of that sort? What would your opinion be?
Yeah, don't take what I said quite literally, though. I mean, obviously, when you need money, you need money, so you need to go and talk to VCs. The point really was that you want to go from a position of strength, not weakness, right? So here's again choreography. This is all about choreography when it comes to fundraise, right? So you need one yes. You may get 99 no's. You got to have very thick skin, right? And that's true, by the way. I mean, my firm passed on, companies that are now worth hundreds of billions of dollars, right? So, VCs, unlike popular thinking, are people. so, we were emotional characters and so on and so forth. But let's say you get a no. Okay, you have an initial meeting. You went to the VC. VC said, not interested. So what you do is, when you leave that meeting, you say, would it be okay if I keep you, notified as and when we make progress? Now, nobody is going to say no, right? Maybe there are a couple of characters on Sand Hill who may, but most people will say, no issues. Now, they may not look at it, they may ignore your emails, but you've got that in. So as and when you hit the milestones, customers, employees, advisors, that continuum, boom, 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 you just keep sending them an email. Don't spam them, but an email every few weeks, just saying, wanted to let you know that we told you we were going to do this. We've actually done it. That's part of the and then what will happen is, at some point, their risk profile will get to a point where the threshold they'll cross, or you'll cross the threshold to becoming less of a risk. At which point they will come back and say, you know what, very interesting. Thank you for keeping me updated. Let's go ahead and meet. And that's how the cycle sort of starts. The other thing is, always get a warm intro, right? Because the thinking that VCs have is, if you don't have the wherewithal to network within my circle, then how the hell are you going to convince employees to leave cushy jobs and customers to buy from you, even though you're a 9-month-old startup? So a warm intro is crucial.
So counterpoint, by the way, on that is, you got to sandbag. Right? The moment you start talking to VC, the clock starts ticking, because they're going to track you, right? So once you start talking to VC, you're here, you tell them, here's my product plans, right? Guess what? You're going to miss them. I guarantee you're going to miss some of the slips.
That's right.
You're going to go back, and you're nothing against being 100% honesty, but you don't have to be 100% honest sometimes, is to say, wait a minute, so you sandbag some, right? If your product plan, you're going to GA, you're going to roll out September 1st. Just say November 1st, right? You miss it by a little bit, you're good. No one knows better, right? So again, it's a dance, right? You gotta manage perception, right? The clock start, like, I've passed on deals personally where I know they're a good team, but they're not good at managing perception. So I start getting into my meta thinking, right? I like them, I want to fund them, but by the time, if I seed them, they go to the Series A, they can't manage perception. I'm not going to get a step up, right? So there's all this meta thinking that's going on in the VCs and investors' head that they like you when you're managing them, because it shows you know the game, right? So that's important.
So under promise and over deliver.
Yeah.
That's yes. So I'll tell you. It was actually in an elevator, believe it or not. By the way, I write quite a bit, and so I just came back from India, and I was stuck in a flood. I was stuck because there was a statewide strike, so no taxis or buses or anything was. So India throws these sort of curveballs, or in cricket term, there's a ball called a googly. So it threw a googly at me, but an entrepreneur reached out to me, said, you know, Mr. Jolly, I know you spend a lot of time sitting in traffic from one meeting to another. Would you mind, and he was brilliant on a couple of levels, would you mind if I hitch a ride with you? So he realized that the best time to have a captive audience with venture capitalists is if you are actually in a car ride between meetings. And it turns out that he was landing at the airport and he needed to get transferred to the hotel anyway. And so he got a free ride, and he got to spend an hour and a half with me. So similarly, there was a gentleman, I actually ended up funding him. He got me actually in an elevator. So, and the funny thing was, he said, I have an elevator pitch for you. I said, shoot. So it turns out it was a company that does electronic waste recycling, right, for India. And now I funded them when they were a seed. I mean, they were a PowerPoint, nothing more than that. But I loved the passion that he had, and he said, I'm putting my life savings into it. And then I knew the market was absolutely massive. And so that's all I was looking for at that time. And I was able to actually get another investor to come along and write a $6 million check for them because they needed a factory, right? So it's not a $250K, a $500,000 check. So when they said, I am putting my family's life savings, so clearly there was commitment. But I told them, please don't do that, because I don't want that on my conscience, because there's a high mortality rate, right? You could lose your life savings. I don't want that on me. So put some, because I want your skin in the game. And I love the market and the approach, and so I funded him. So that was a real elevator pitch. You probably have a bunch of examples.
The best one I've seen, and this, by the way, has been written about. So I think the best elevator pitches are demos, right, where you actually get to experience the product. And the best one I've seen is Twilio. You guys know Twilio? All right, so they just went public, $3-4 billion, right? So the pitch is very simple, which is, so the founder says, I'm gonna abstract all the messiness of telephony, how you generate a call, how to set up, tear down, all that kind of stuff, as well as SMS and all that stuff, into 5 API calls. That's it. And by the way, these API calls are very well defined, easy to use. So what he did for his very first VC round he was raising, he'd go around meeting with people, and what he did was he'll sit down, he'll give the pitch, and people will be like seriously? I don't believe you. Then he'll say, what's your cell number? So open up his laptop, all right, I'll get your cell number, spend a minute writing a little piece of program that generates a call to the phone in like 2 minutes. Like mind blown, right? It's like, so I love things like that where in a few minutes you're able to demonstrate what is essentially a very compelling value of wide applicability. And I think that's, when I think about like awesome demos that kind of hit hard, that always has been my canonical use case in my head, which is if you can do that, you don't need a deck. You don't need like a exact summary or whatever, right? It's like you do that 5 minutes. All right, let's go talk about how you're going to get to market, how you're going to get the first 10 paying customers. You get to the brass tacks. So I think, yeah,